Hello everyone and welcome back to our YouTube channel. We will continue now to explore the basics of the balance sheet. In our previous lesson, we explored the balance sheet and how it balances with assets and equity. Today, we are going to dive into the other side of the balance sheet, liabilities. No, it's not dark matter or something mysterious. Liabilities are simply obligations, things we owe to others. And as already discussed, liabilities should always balance with the assets of the business. You may already be familiar with liabilities in your personal life. Have you ever borrowed money from a friend or taken a loan? That's a liability. Businesses operate in a similar way, and these obligations are reflected in their balance sheets. In simple terms, liabilities are amounts a business owes to external parties. This could be suppliers, banks, individuals, or other lenders. Liabilities are a crucial part of financial management because they allow businesses to operate efficiently without needing to pay for everything upfront. Remember how in our last session we learned how businesses buy apples, making immediate payments? At the same time, we also looked at the scenario where we waited until our customer paid us, and instead of cash we had receivables on our balance sheet. And then, in some time, the customer paid us and we finally had all our cash back. But what happens when a business delays payments to its suppliers too? Let's explore this scenario. So, let's start with our basic balance sheet and full cash available for our needs. $100. Let's say we want to buy 5 apples at $10 each as we did before. But now, instead of paying immediately, we arrange to pay the supplier later. Here's what happens on the balance sheet. We put apples onto our balance sheet and inventory increases by $50. 5 apples times $10 each. But cash now remains unchanged because we have not paid for the apples yet. We have the full balance of cash which we can use for some other needs. What is the result? Now the balance sheet appears unbalanced. Assets 150 consisting of 100 in cash and 50 in inventory, and equity 100. We need to fix this. To correct this, we introduce a new line on the liabilities side, called Payables or Trade Payables. Let's simply keep calling it Payables. Since we owe our supplier $50, we record it under Liabilities or Payables. Now the balance sheet balances again. Assets 150, cash plus inventory, equity 100, liabilities 50, trade payables, and total equity and liabilities 150. Cool, we've done it and fixed our balance sheet. What's the next step? You cannot keep your supplier waiting forever. After some time, you decide to pay the supplier. You pay them all $50 you owe them. What happens to the balance sheet then? Cash decreases by $50 since the payment is made, and trade payables liabilities decrease by 50 since we no longer owe anything. Now the updated balance sheet looks like this. Assets 100, cash 50, inventory 50, equity 100, liabilities 0, trade payables were cleared, equity and liabilities in total 100. Again, the balance sheet balances. This process shows us how we can manage our balance sheet and funds while keeping everything in equilibrium. Great, we've done it! Continued with our business and got to know how we can manage our suppliers. But why would a business want to have liabilities? Companies strategically use liabilities to manage their cash flows. Here's why. For example, timing of payments. If a business is waiting to receive payments from customers, it may not have enough cash to pay the suppliers, but need to purchase goods to keep the business running. As a result, it might delay paying its suppliers. Cash management. Even if a company has enough funds, it might prefer to hold onto cash longer to ensure liquidity for other expenses, or it has better options to use it in the meantime. Financing. Businesses sometimes use credit arrangements instead of depleting their cash funds immediately. Managing payables efficiently helps businesses operate smoothly and maintain financial flexibility. Okay, let's wrap up the payables topic. liabilities play a crucial role in business's financial structure. Here's what we learned today. Liabilities are amounts owed to others, in our case, suppliers. Trade payables arise when businesses buy on credit instead of paying immediately. Paying off liabilities reduces cash but balances the books. Companies use liabilities to manage cash and maintain flexibility. In the next session, we'll dive deeper into how businesses handle receivables and payables together to manage their funds. Thanks for watching. We hope this lesson helped clarify liabilities. Don't forget to like, subscribe, and hit the notification button for more lessons on accounting and finance. See you next time.